All right. Good morning, good afternoon, good evening. Monday market update, and good morning, good afternoon, good evening, depending on when you're watching and where you're watching. I'm Matt Gouget, founding partner at U Mortgage. I've got Nash Paradise, my partner in crime, who's joining us shortly. He's putting the final bows on some Christmas shopping, so he'll be on shortly. But really interesting discussion this week, because last week was Fed week. A lot of volatility in mortgage rates, a lot of confusion about why mortgage rates did what they did last week, where we had the Fed lower the Fed funds rate by 25 basis points, but we saw mortgage interest rates go up. So we'll talk about that. We'll talk about the future of mortgage interest rates. I think I'm going to talk to my buddy Nash about some store closures, some stuff that's happening in the economy, because he's dialed into how all that data affects mortgage rates. Mortgage rates affect the real estate market. So if you're watching this and you're a consumer, you're a real estate agent, you're a fellow loan originator, you want your finger on the pulse on what's going on in the real estate market, and everything ties in: the economy, mortgage interest rates, buyer sentiment, all kinds of stuff, right? And so 2025 looks like it's going to be an interesting year. In my opinion, it's going to be a year where people who are paying attention and doing the work are going to find opportunity, and those who don't are going to bury their head in the sand. They're either not going to take any action, which most people know from an investing standpoint, or really from a life standpoint, isn't the best play, right? Like inaction is never the winning formula. So we'll talk about all that good stuff. And I don't want to talk too much about last week and the Fed before I've got my buddy Nash on here. Maybe we'll do it kind of reverse. We'll pull up some slides on what they're projecting for the future. And then when we talk about last week, I'll wait until I've got my buddy Nash on here. So do we have slides, Caden, where I can look at what the Fed's projecting? First off, here's mortgage interest rates. And I'm not sure what day this must have been Betterment on Friday. We set dip back down. But as you can see, the latest upward trend at the end was last week's Fed meeting, where rates ticked up quite a bit. We'll wait until Nash is on. We'll talk about that. And then we got a little bit of retracement, little bit of backtracking on Friday, where we got 20 or 25 basis points left there. And so I'll talk on this while we're waiting for Nash. Mortgage interest rates. If you want the cliff notes, what are mortgage interest rates going to do in 2025? A lot of projections. There's like 10 or 12 that you can look at between Mortgage Bankers Association and Redfin and Zillow and National Association of Realtors and Fannie Mae and Freddie Mac. And when I looked at those last week, I think I had a note around here somewhere. They've got a range, and then they've also got an average, and Redfin was near the top of that estimates 6.2 to 7.2 with an average of 6.8 for 2025. Those 10 or 12 that I listed, including Goldman Sachs and Housing Wire and, Wells Fargo and First American and Realtor.com, National Association of Realtors had a range of 5.75 to 6.25, so a 6% average. They were at the bottom. I'll get you caught up here shortly, Nash. I'm just talking about mortgage rates 2025 in general. I'm waiting for all the nitty gritty stuff because you're the nitty gritty guy on what the heck happened last week. So much excitement around mortgage bonds, so much excitement around that Fed meeting and what was said. I'd love to go back to that. People are confused, and I think that part of our job is to help fellow loan originators, real estate agents, consumers, anybody who is taking time out of their day to listen. Like, why did mortgage rates do what they did last week after the Fed cut the Fed funds rate by 25 basis points? People don't understand what happened.
Oh, and that's for me. Okay. Hey,
Yeah,
if I knew exactly what happened, we'd be having a good time here. But, there's not a lot of there's not a great explanation here. We hit on the numbers. All the metrics were fine. We got the quarter Fed funds cut like we expected. It was, if you had to pin it on one thing, we would say that it was the comments by Powell and the fact that we're looking at a lot less movement next year. The Fed is anticipating things to be higher for longer, which is basically what we said a few weeks ago when we were talking about this, which was our analysis. However, seems the markets weren't prepared for that. It's almost they were looking for something better.
Yeah, and that's kind of funny because I don't know. I want to run back the tape. Like last Monday, I remember specifically being relatively certain that the advice I gave clients to lock was good. And I told people, warning, the Fed's going to cut the Fed funds rate and mortgage interest rates are going to go up. And the reasoning was we kind of knew that the talk around what 2025 would hold, the Fed was going to continue to kind of revise down how aggressive they were going to cut. And they were going to kind of have to because of, being data dependent, and there wasn't stuff in the data that could, the inflation kind of worry and, the numbers around the job market, the economy, like just didn't justify them coming out and being like, yeah, we're going to cut 5 times in 2025. The latest projections are like 2 cuts all year. And that I think is what spooked the market. And,
I'd agree. I mean, if you look back at forecasts previously, the interest rate projection for 1 year from now was 3.4%. That would have signified another 5 cuts. That's what we're looking. That has been revised all the way up to 3.9%, which puts us at 2 to 3 cuts. It's not good. I mean, that's the biggest factor is we're going to see a lot fewer cuts next year. We're going to see a lot less movement, a lot less activity by the Fed. It is going to continue to be data dependent, of course, but man, I mean, what do you do with that? We got all the numbers that we wanted. Everything was in line. Housing starts hit right. Building permits were fine. Philly Fed was cool. GDP was a little high for Q3, but I mean, not enough to make a difference. Yeah, nothing was crazy, but it's just everything out of the Fed's mouth. And these forward-looking projections, you look at all the projections, the 2-year, the 3-year as well. Like the 3-year stayed pretty consistent. We got a projection of 2.9% Fed funds rate with the dot plot signifying about a 3.1. That's fairly consistent, but you look at the 1 year is 0.5% off. The 2-year from 2.9 all the way up to 3.4. We've basically taken 1 year worth of movement that we were expecting and stretched it out into 24 months.
Yeah, which is it's funny you mentioned it. Somebody on a TikTok video or something was telling me like rates aren't coming down, and I said, well, they're not coming down as much or as fast as we anticipated, but over time, I still think they come down. And whether that's middle of 26, Q4 of 26, first half of 27, I don't know. But they're eventually going to come down. I think the Fed's just, playing it safe and moving slower. one thing I'd love to ask you about before we look at some charts, Nash, is like,
Mhm.
what could change that if, because and I'll tell you where I'm going with this. I keep looking at numbers that have to do with the economy and unemployment and stores closing, and I'm like, are there some chinks in the armor? Are there some reasons in the future that the Fed would be like, oh shoot, I need to maybe rethink, cut a little bit? Because if people don't understand, like, cutting interest rates stimulates the economy in a simple kind of just explanation of it. So it's like, oh, economy's having trouble, people are out of jobs and it's kind of like stalling. A couple cuts stimulates money movement, stimulates the economy. And
Yeah.
so what do you think about, that kind of out there, being that of all the data dependent things, if we start seeing a sputtering economy, will that change the Fed's trajectory?
Sure, possibly, maybe we'll see. But like you said, the reason for rate cuts: when money is cheap, you spend more. When money is expensive, you spend less. When people spend less, the cost of things come down. That's why the Fed takes action to try to move inflation. When money is more expensive, you spend less of it. When you spend less of it, pricing comes down. It's just simple, basic macroeconomics. So, looking at what are you seeing on the news lately? Well, we've got a bunch of stores closing. Big Lots getting rid of them here. Party City, those are all shutting down. Problem isn't necessarily these closures, because these closures they've been coming for a long time. This is the degradation of the brick and mortar. It is too expensive. There's a bunch of stuff in my local area here in North Texas, which has always been a thriving market for small business. They just can't compete. I mean, when we set up these, mega convenient options like Amazon, when people are able to go hard on Temu and AliExpress and Shein and things like that, you just can't compete. The costs are not, like, it doesn't make sense. As money gets more expensive, people are going to go for the most economical option possible. So these stores closing, these businesses shutting their doors, that's not necessarily indicative of less spending. It's more indicative of price conscious spending. People are choosing to spend their money in the most affordable way possible. But looking at the numbers, and you check the GDP for Q3 and the sales, like they're still right in line with projection. They're still up. So the money is still being spent. It's just being reallocated into things that are less expensive, in my opinion.
Yeah, I think you're exactly right too. People are still spending. I can only speak for myself, but plenty of Amazon packages arrive on my door every single day. My wife is making sure that she contributes to the GDP numbers, and that we don't slow down at all as
Oh,
a country.
Santa's on has been very, very busy at our house as well. But that's the thing, when you can sit there at night, 9 o'clock, hanging out in bed, talking about Christmas lists for the kids, and I can go and put 9 different things on here from all sorts of places. I can find it all on Amazon, or I can go to 6 stores tomorrow and waste 4 hours of my time. What are you going to do? Like, it's
Yeah,
just the nature of the way things are moving. So,
yeah,
if we see more businesses close and we see more things start to suffer, really what for me has always been a really good leading indicator has been airlines. If we start to see ticket prices plummet, if we start to see hotels have a lot more vacancy, when people stop traveling, that's usually a sign that things have just gone too far. And that's like the first thing that people cut out, is that extra type of spending, the fun stuff. It's funny, like I watch a bunch of different, I've got more hobbies than I can count. And so I pay attention to like high-end guitars and watches and exotic cars. And you start to see like prices are coming down on that stuff big time, especially in the watch market, exotic car market. Like guitars, man, I can't sell anything right now. When money starts to come down on that big ticket luxury stuff, that's usually an indicator that it's coming for everyone else. So I think in the next 6 to 12 months, yeah, we're going to see a little more squeeze, a little more recession-esque activity out of the average consumer as these prices stay higher for longer, as rates stay up, as spending slows down. It's not going to be a fun couple of years, in my opinion.
yeah. No, I think I'm seeing it and feeling it. The conversations I have all the time, people are not exactly flush with cash. And while we're speaking of dropping prices, let's get a question in before we look at charts, because
Let's
Robert
do it.
C in the comments had a question. It was specific to Texas, so we're going to hand this off to
Ooh.
Nash as a Texas boy. And, a good point about prices. And he says, why do people keep overlooking cities with real housing price drops like Austin, down from 20% from the peak? We have never seen any price drop in any large cities since the great financial crash. Is that what GFC is? So what says you about, Austin, with a major pullback? I've got my, thoughts about it, but let's hear from the Texas boy.
Yeah, man, I'm going to go against the grain here a little bit, and it's not a drop. When you go up 40% and then settle down 10 to 11% on average, it's not a real drop. It's a balance. I mean, look at any kind of markets. When you're going normal, then you have a spike and a settling. That's a overreaction followed by a reaction. They went up too fast. Obviously, there's a shortage. Supply and demand does what it does, but we're seeing it up here in the northern Texas. I'm in the Dallas-Fort Worth area, and it's a lot of the same. Not as severe as Austin. There's a massive building shortage. There's a lot of money, a lot of influx there. People are overpaying. And we just look at the cost per square foot on things. When you're getting up to $300, $400 a foot for sticks and bricks, like, there's a lot of room for that stuff to fall. And that's what we're seeing right now, is that $600,000, kitty condo that's 1,400 square feet because it's in that hot area is now a $520,000 condo, a $500,000. Like, it's still one of those things where you just look at what's the cost of materials? What is it taking to build this? And there's room for it to continue to fall, as there's just no demand right now. There's not a lot of people moving for work. They're starting to balance out some new construction. So for me, the drops in a lot of these areas, they're not real drops, because we're still just taking back some of the gains that we've had in the last 3-4 years.
Yeah.
If we look at that history, the 3-year, the 5-year, 7-year, 10-year, as we start to get around those averages and take it on a longer scale, it could still go down, it could still drop, but again, it's just giving back gains. We're not into a net fall over a short enough period for me to call it a legitimate drop.
Yeah, I agree with you. It's a pullback from hysteria, and Austin was one example where, there was a lot of people wanting to move there. There was limited inventory. And so, like you said, people were overpaying. And then, you pin, like, the record price in June of 22 or whenever that happened, a lot of different parts of California, like the summer of 22 was kind of like that mass, like, oh my gosh, rates are headed up. Well, I can still get a 4.25. I'm willing to pay 1.1 for this thing that was listed at 949. And so, of course, you pin that 1.1, like, oh my gosh, you can buy that same house for 925 now. Well, yeah, somebody probably shouldn't have paid 1.1, right? And that was like the peak of hysteria, and now we're pulling back from that. And so, yeah, we'll see. But to your point, like, if you look at a 5-year window and you're like, oh, 3 years, they saw 53% appreciation and they gave back 13 of it, like, it's still an upward trajectory. So, I wouldn't be overly concerned about it, like, to cause real great financial crisis type crash. You need mass flood of inventory. You need defaults. You need all this stuff that just can't happen when we've got default rates that are at all-time lows and whatnot. So shout out Ashton Hamby for joining in the chat. Appreciate you.
To Robert's other point, which I think is a very popular point, I've seen this a lot on social media, is I don't know if this is healthy. And I just wanted to offer my thoughts on that. Like, yes, this is healthy. It is healthy to have this kind of a pullback. We have to have an ebb and flow in the market. You have to be able to bring in new buyers to replace move-up buyers. You have to have enough new construction. Like, right now, what's been happening is all the movement in some of these metropolitan areas, you have completely left out 60% of the workforce. You've left out everyone making less than $120,000 a year, which is the median household income in most of Austin. If they can't buy, you're gonna have you're gonna run into issues. You have to be able to have, in order to have a healthy system, you need homes that can be purchased by someone making 80% of AMI, area median income. And for a while, you didn't have that. You still kind of don't have that. So these prices coming down. Now you can lose, and like you're looking at loser number one right here. I had to buy a new house this year in July, kind of the top of the market in an exclusive neighborhood that only had one listing that we had to get into. That's a different story, but I overpaid, and it appraised high even after I overpaid. There's no way it's worth what I paid for it. And as you can see, I've still got to paint walls and finish doing my office here, but next year this home could be worth $50,000 to $75,000 less than it is right now. But I'm not in it for 1 year. I'm in this long term. So like, can you lose in this market if you bought in the last year? If you sell in the next year, sure, yeah, they could keep going down. If you buy 6 months from now, could you still lose value over the next 6 to 18 months? Absolutely. It's plausible depending on where you buy, the square footage, price per square feet. If it's a unique property, you have to overpay to get. We need to get back to thinking of housing as more of a long-term solution instead of a 2 to 4 year strategy. You shouldn't be looking at your house like outperforming the S&P 500 and basically functioning like cryptocurrency. You're not getting that 50% return in 3 or 4 years. Historically, homes have appreciated about 100% every 10 to 12 years. Then it went down to about 7. And then for a while there, at certain price points, it was 4 to 5 years they're doubling in value. That's what's not healthy. We've got to be able to have a market with enough balance to where everyone can participate, or the bottom's going to fall out of it.
Yeah. We want to return to healthy. I think California, that gets pooped on all the time. Over the last 40 years, like 6.8% per year appreciation, which is great. You start getting 15, 20% in any given year, especially at the prices that we have out here. Then it's trouble. And before I forget, when you talked about 300 to 400 a square foot, Nash, out in California, we call that affordable.
That's bizarre. And you know what? I think we're going to get back to a spot where we start just building smaller homes. But again, what we talked about last week or the week before, the cost for construction before you even pour concrete, almost $100,000. It's probably over that now. It's too hard to build a 12 to 1,300 square foot home. And, the solution here is high density housing. And no one wants to hear that. The area that I live in, fairly affluent, average median price, I think, is in the low 700s. And that's a 3,000 square foot home. Lots of $1 million properties. I mean, this is North Texas affluent. This isn't California affluent. But it's a spot where they don't want more people, where traffic's crazy. Like, how do you meet the need of the many and have housing without pissing off all the old people who have been here for 30 years and want to maintain the characteristics of their small suburb? Someone's going to lose, and I don't really know where that's going to go in the next 10 to 15 years.
Right. Yeah. We keep adding people, so I think we got to add more housing. You want to look at the charts? I think we have 3 Fed meetings the first 5 months of the year. We can talk on that. Is this January? Is this a January stay pat, almost guaranteed? Is that what I'm looking at?
Yeah, January not moving. We know where we are. There's not going to be a Fed drop in January. I think that 8.6% is just some holdover that maybe haven't updated their dots yet. But no, we're not moving in January. I'd be curious to see what March looks like now. Interesting. So I think most of us are forecasting at this point. Most people are still forecasting 3 drops in 2025, although it could turn into 2, which could make interest rates on mortgages even worse. But I think now the majority, funny enough, this is very different a week ago. The majority now are saying continued no drop in March, which is, still almost 50-50. But yeah, I don't think we're going to see a drop in March either, but that's going to be highly data dependent on first quarter data that we don't really know what that's going to look like. We don't know the impact on the Trump presidency. What do you think, Matt?
Yeah, I think you're right. Like, it's going to be data dependent as of right now. Like, it just seems like a lot of people were not in agreement with the December cut. They think that the Fed should have paused December. So now it's like, if you're going to do that, take a few months off, see what the new presidency holds and how that affects the market. See, all the stuff they're looking at, the inflation numbers they're looking at, the jobs and economic numbers they're looking at. And so, we can look out, and we can even look at May's the next one, but really it's going to depend on what data comes out in January, February, and March, what the economy looks like, in January, February, March, to really know how 2025 is really going to shake out. But is that far right one that's still like the
Yeah, so take a look, man. This is May, and we haven't talked about May. We haven't gotten to May. We've been stopping at March because we've always been talking about the importance of the December and January meeting. Obviously, I'm on record here consistently of saying I didn't think we needed a December cut, that it would have made more sense in January. And I'm going to say that the market response to the December cut would signify that I'm probably right. Doesn't matter because it was coming anyway. They just wanted to get it in. But yeah, look at May. We are still showing I guess not. Majority are saying one more cut in May, but man, that's close enough to down the middle on those two that we should be. We could very well not even see a cut by May. As spring spending starts to ramp up, we could go, 3 more meetings. We could go all the way into June before we see a cut. And I think that's really going to worry some people about the direction of the economy next year.
Yeah, I think the last few minutes I'd love to just wrap on, people are like, well, what does all this mean for 2025? What I started with, I think before you jumped on, was I expect some of what I saw Q4 of this year. A lot of opportunity for people that are paying attention and for people that are unaffected by, short-term cost of money. Oh my gosh, my rate is 7.25. I'm not going to buy. I'm going to wait until something magic drops in my lap to kind of fix my own personal affordability issue. I've seen so many people win, whether it's an investment property, whether it's primary residence, a property that we got in contract last week, just negotiated a lesser price and a credit on an already great deal because the roof is a little bit shoddy. But like, you wouldn't have dreamt of this deal this client got in the summer, and you wouldn't have dreamt of this deal anytime in the last 18 months, this neighborhood, this condition, this house at this price. Like, it just would not have happened. And so I see a lot of that happening in 2025, while people who aren't, willing to do the work and kind of search for opportunity just sit back and complain and wait and think that, like, waiting out the market is going to somehow solve their problem. What do you think, brother?
Half and half. Let me disagree with you first because that's more fun. So I don't think a lot of people are sitting back watching the markets. I do think a lot of people are sitting back who already own homes and already have interest rates that are low. I think that is a relatively wise fiscal decision. If you're sitting on a 3.75, a 3.25, a 2.5% interest rate, you should have less motivation to go and buy something with a 7%. You've got to take the entire context of what that move looks like to you. And yeah, you can get that next house at a better price, but you're also going to be impacted on your sale. And depending on what price point you fall into, you may be losing a little bit of money. That the problem is, it's kind of like Monopoly. You get all that money in your hands, you get all those houses, hotels, you think that's part of your net worth. Now you start taking inventory of it and saying, hey, this is mine. Next thing you know, when it comes time to sell, and you're like, wait, my house is worth 380. No, well, now it'll sell for 340. And now you got to pay fees on that. And now you're going to buy the next level house for $500,000. Yeah, it used to be worth 600, but does it really make sense to jump into it at 7%? So I think a lot of people are going to go to the math and say, not right now. The math doesn't, they're going to wait for a more balanced market, just because it doesn't make sense to add $2,000 a month to their mortgage payment to jump up to that next level home. Now, for the people who don't currently own or need to move up, need to relocate, things like that, I think they're going to be looking. We've had rates this high for so long. I think most people are comfortable enough with the high 6s and low 7s that's not going to be too much of an influence. It's not like we drop down into the 5s for very long and they're like, well, I expect things to be at 5.5, but now that's gone. So I think they're going to be looking and saying, oh, well, this house was listed for 680 and then 660 and now it's 630 and it's been on the market for 4 months. Maybe I can get it for 600. They're going to start doing that math in their head, and they're going to be thinking, hey, for my 7 to 9 year, projection on this home, I really like where I think this value is going to be at that point. And I know I'm going to refinance at some point. So like you said, we're seeing winners in this market. We're seeing people take advantage and capitalize. But I think it's going to be people with a little bit of a longer plan You're not going to see a lot of people winning big when they're saying, hey, I just got to get into something and we're going to buy this and we can upsell in 2 to 3 years. I don't know that that's going to work out quite as well at most price points. You got to be definitely on the lower end of things in order for that to come to fruition.
Yeah, I agree, man. And yeah, you should, like you said earlier, you shouldn't expect 2018 to 2022 type appreciation. Like nobody should expect to buy a house and have it be worth 75% more 4 years later. So thanks for joining me, brother. Merry Christmas.
Yeah, man.
To Nash Paradise and family. I appreciate you, brother. Next week we'll jump back on and see what the end of the year brought us.
Yeah, man. Sounds awesome. Merry Christmas to y'all as well. Take care.
All right. Later, man.